The Greek Debt Crisis, a Modern Case Study. Introduction. A Nation on the Brink. In 2015, a modern European country teetered on the edge of complete economic collapse. Banks shuttered their doors, ATM withdrawals were limited, pension payments were halted, and the nation known as the cradle of democracy and philosophy had to sit at the negotiation table with international creditors just to stay afloat. This was not a tale from history. It was a real, contemporary tragedy. Despite being part of the Eurozone, a member of the European Union, and operating with one of the world's most stable currencies, Greece was pushed to the brink of default like a crumbling empire. How did it come to this? How does a developed nation sharing a currency with Germany and France and backed by international institutions end up dependent on one bailout after another? And even if you've never set foot in Athens, why should this matter to you? Because what happened in Greece was not merely a local crisis, it was a modern example of how the global financial system truly operates, how debt can be used as a political lever, and how quickly sovereignty can erode when financial flows dry up. The seeds of crisis. Joining the euro. Let's go back to the beginning. The steps that sowed the seeds of the crisis were taken long before they hit the headlines. In 2001, Greece adopted the euro, gaining access to low-cost borrowing it had never experienced before. For decades, the country had been known for high debt levels and substantial budget deficits. Yet with the euro, markets assumed that risk was now shared. Greek bonds were perceived to be almost as safe as German ones. Suddenly, Greece could borrow at historically low interest rates, and it did, extensively. Public spending surged. Infrastructure investments boomed. Public sector salaries rose noticeably. While some of this money went to roads, airports, and modernization projects, much of it fueled an inflated bureaucracy and an inefficient tax system. Corruption was widespread, and tax evasion was rampant. Government revenues could not keep up with expenditures. Beneath the optimism of the 2000s, the country's debt kept growing steadily. The Unraveling, Global Crisis and Exposure. By 2008, when the global financial crisis struck, Greece was already running one of the largest budget deficits in the Eurozone. The collapse of Lehman Brothers sent shockwaves through global markets. Investors began scrutinizing government debts much more closely. When they examined Greece, the numbers simply didn't add up. At the end of 2009, it was revealed that the country had been underreporting its deficit for years. The real figure was around 15% of GDP, far exceeding the limits set by the EU. Confidence evaporated overnight. Borrowing costs soared. Greece was shut out of the bond markets. By 2010, requesting a bailout from the European Union and the International Monetary Fund became the only viable option. Austerity policies and their consequences. Bailouts, however, never come without strings attached. The first package of $110 billion demanded massive public spending cuts, tax hikes, pension reforms, and labor market liberalization. These austerity measures were designed on paper to reduce the deficit and restore investor confidence. In practice, however, they plunged Greece into a much deeper economic recession. The economy contracted. Unemployment soared above 27%. Youth unemployment exceeded 60%. Public services collapsed. And the debt, the very problem the bailout aimed to solve, continued to grow. The uncomfortable truth no one wanted to admit was this: when an economy shrinks, the debt-to-GDP ratio inevitably worsens, even if you are repaying loans. By 2012, Greece needed a second bailout, this time 130 billion euros, accompanied by an unprecedented haircut for private bondholders. While technically not a full default, it was essentially one in practice. And yet, the debt burden remained unsustainably high. The referendum and loss of sovereignty. The crisis dragged on for years. Each new bailout brought more austerity, stricter conditions, and weaker economic growth. In 2015, under the Syriza government, Greece held a referendum to reject the terms offered by its creditors. The no vote won decisively. Yet just days later, the government accepted an even harsher deal. Why? Because the alternative, leaving the euro, returning to the drachma, and declaring full default, would have been catastrophic in the short term. From that point on, Greece's economic sovereignty was effectively gone. Its budget, tax policies, and public spending were now dictated by the Troika, the European Commission, the European Central Bank, and the International Monetary Fund. Historical parallels. Debt as a weapon. What happened to Greece was not unique. The mechanism is ancient. Debt has always been a tool of power, a weapon in diplomacy, and a means of control without armies. In the 19th century, the Ottoman Empire experienced a similar fate. Following repeated defaults, European creditors established the Ottoman Public Debt Administration, taking control of customs revenues. In the 1870s, Egypt faced a comparable situation. After taking on large loans to finance railways and the Suez Canal, Egypt defaulted. Britain and France not only acted as creditors, but effectively became administrators. In both cases, the empires still existed on paper. Flags flew, leaders spoke, but real power lay in the hands of the creditors. Greece experienced exactly this in the 2010s. Not a military occupation, but a financial trusteeship. The Troika became a shadow government, deciding what could be cut, where money could be spent, and how quickly debts would be repaid. The human cost and persistent debt. For ordinary Greeks, the crisis was brutal. Pension payments were slashed. Hospitals ran out of essential supplies, and thousands of small businesses closed. The social fabric deteriorated. Yet the debt remained high. Even today, Greece's debt-to-GDP ratio is above 160%. The economy has stabilized, but at a much lower baseline. The cost of survival was a lost decade of growth. Modern relevance. Lessons for today. Why does this matter now? Because the same forces that crushed Greece are still at work. Today, countries like Sri Lanka, Pakistan, and Argentina wrestle with heavy debt burdens, IMF programs, and the trade-offs between austerity and sovereignty. The names may change, but the structure remains the same. Look at advanced economies. Italy carries one of the Eurozone's highest debt loads. Japan's public debt exceeds 250% of GDP. The United States' total debt has surpassed $34 trillion. Large economies can delay the reckoning, but delay does not mean immunity. The key lesson. Greece's crisis was not just about numbers on a spreadsheet. It was about lost flexibility. When you can't print your own currency, when you can't devalue, and when you rely on external financing, control is no longer yours. The same applies to individuals. Debt reduces freedom, narrows choices, and ties you to someone else's rules. Conclusion. Fragile financial freedom. Greece's collapse was not a classical destruction, no armies, no conquests, but it was, in practical terms, a surrender of sovereignty. And it occurred within one of the world's most advanced economies under the watch of global institutions designed precisely to prevent such crises. History does not repeat exactly, but it rhymes. Seeing a modern nation fall into default like an empire highlights just how fragile financial freedom truly is. History is full of lessons. Subscribe to explore them together.